Ladies and gentlemen, welcome back to Boss Economics World. Yes, you've heard it right. Today we'll dive into the latest installment of how central banks, through their impeccable sense of timing, are yet again proving their uncanny ability to act too late and too wrong. First up on the agenda, the European Central Bank, ECB. An epitome of dithering bureaucracy now rushing to correct its policy course with an interest rate cut that it swore wouldn't happen just a month ago. Sound familiar? All eyes are on the ECB's upcoming meeting, expected to deliver a mind-blowing global push for monetary easing. Why? Because after months of enjoying their little experiment of high borrowing costs, they now suddenly realize these rates may have actually been strangling growth. Who would have guessed? So what do we have? Analysts foresee a quarter-point rate cut, a futile band-aid that just might be enough to signal the start of a frantic rush to reverse the damage. But wait, a month ago ECB officials were clear. No cuts. Not yet. Slovakian Central Bank Governor Peter Kazimir, with the certainty of a fortune teller or perhaps an economist with a crystal ball, assured us that the ECB wouldn't make a move until December because, get this, there'd be very little new information by the October 17th meeting. Fast forward a few days, Europe's economic outlook hit with survey data showing contraction in the private sector. Surprise, surprise, and out goes the non-cut plan. The about-face is so fast you'd think Lagarde was hosting an economic hokey-pokey. So yes, on to Thursday's meeting in Slovenia. We'll see ECB President Christine Lagarde sitting there, likely scrambling for an explanation. What changed? What made them flip-flop? Was it that enduringly high inflation? Maybe the sluggish European growth? Some might suggest the ECB has realized it's been tightening the noose around its own economy's neck for far too long. Imagine how radical a thought that is. Maybe, just maybe, crushing demand with elevated borrowing costs wasn't the best solution to an inflation problem that stems from supply-side pressures. For those stuck wondering how we got here, let's not forget the ECB's initial bluster about fighting inflation at all costs. High inflation, they said, needed to be combated. Let's throttle demand with tight monetary policy, they said. Of course, inflation wasn't solely driven by demand but by supply shocks. Rising energy prices, broken supply chains, and geopolitical tensions. But because they were so determined to stick to their tightening narrative, they ignored the clear warning signs coming from every corner of the global economy. Those stubborn high rates led to stagnation. Companies couldn't afford to borrow. Consumers drew in their wallets. People lost jobs, and economic activity crawled, if it moved at all. Oh, and let's not forget Europe's poor industrial output spiraling under the pressure. Now, as Europe's governments enjoy their political debacles and flirt with fiscal irresponsibility, the ECB takes on the hero's cape, clumsily, as if to patch up the glaring mess they've exacerbated. Our dear Germany? Yes, the so-called European power engine has now stalled spectacularly. Are we surprised that Europe's largest economy is predicted to contract? Not really. Germany, once hailed for its industrial prowess, is finding itself unable to skirt the rebound effects of skyrocketing energy costs and a mismanaged policy response. Just look at the ZW survey of German investors. It's a glaring red alert, signaling investors' waning confidence as they come to terms with a negative growth outlook. Even amidst warnings and data screaming, "Take action," the German government continues its slow dance towards acknowledgement, let alone solutions. Look, it's not just a numbers game anymore. The Eurozone, driven by Germany's weakening economic pulse, is on the brink of a prolonged stagnation. Fiscal stimulus? Nowhere in sight. But don't you worry, ECB's got it all figured out. Cut rates but not too much, keep inflationary concerns at the forefront, and somehow hope that their pull will magically steer the economy into a soft landing. And if Europe is stumbling, China, on the other hand, might make you think it has fallen into an economic abyss. Chinese data for September paint a grim picture. Stagnant property markets, faltering industrial output, sluggish retail sales, and its ever-entrenched deflationary pressures. Problems so deep that even their aggressive easing can't mask the fundamentals. Let's talk about China's 5% growth target, a goal that seems like a relic of a pre-pandemic world. For the last quarter, actual growth remains far below the target. And, shockingly, these numbers come despite Beijing desperately attempting every stimulus under the sun. Scrambling, officials introduced wave after wave of seemingly strong support measures. Yet growth remains weak, unemployment keeps climbing, and factory gate prices are still falling. The harsh reality here is that no matter how many times Beijing hits the reset button, challenges persist. Ghost cities remain. Real estate players like Evergrande struggle for survival, and China's carefully engineered miracle seems to be running out of steam. Move west, and the U.S. enters the economic arena with its own set of troubles. Despite some resilience in U.S. retail sales and consumer spending, cracks are starting to show in the American facade as well. The manufacturing sector has been sluggish, to say the least. The Fed, those masterminds who have been toying with the idea of sustained higher rates, must now deal with evidence of a cooling industrial sector. Retail sales? They're up, but the bear is already breathing down their necks. Meanwhile, let's not forget our friends to the north. Canada. The Bank of Canada, BOC, seemed thrilled when inflation finally touched the coveted 2% mark in August, only to see things muddle in September as anticipation grows for further cooling. But Canada's economic engines are sputtering too. Employment figures might hold, but cracks are visible across all sectors. Growth is slow, and a potential recession might be on the horizon. Once again, policymakers are playing a guessing game that may leave economic analysts shaking their heads in disbelief. So here we are. Across the world, major players are treading water, clinging to inflation targets that seem more like fictional aspirations * each day. The US, Canada, China, Europe, each region is lurching from crisis to crisis while offering the occasional optimistic piece of data to buy more time, hoping that their problems magically vanish. Even the slowing inflation in the UK, finally creeping below 2% for the first time since mid-2021, can't mask the bigger elephant in the room: an economy battered by labor shortages, high debt, and fiscal mismanagement. Inflation falling below target, perhaps the worst possible victory in a country teetering on economic stagnation. Because, newsflash, lower inflation doesn't necessarily mean better growth. It can suggest a recession too. And speaking of recession, let's get back to Christine Lagarde's dilemma. As ECB flounders with its interest rate yo-yoing, it faces not just inflationary but stark economic risks as the Eurozone grapples with potential deflation, poor industrial output, and failing consumer confidence. Yes, they cut rates because what else can they do? But at what cost? Let's not even begin with South Africa, riddled with soaring inflation from fuel costs, or Turkey with hyperinflation, a central bank rate hovering at a mind-boggling 50%. At this point, monetary policy in these regions reads more like a comedy script than a serious economic framework. Here's the bottom line, folks. Behind the jargon, political spin, and fancy central bank acronyms, our global economic framework looks more like a house of cards prepped for demolition. Central banks have tied economies in knots with volatile interest rates while governments continue to deliver paper-thin stimulus measures at great cost with minimal real returns. Think we're nearing a resolution? Fat chance. Policymakers are likely doubling down on more short-term tricks instead of long-term strategies. The monetary authorities are like chefs in a half-burnt kitchen, throwing together half-baked ideas in a last-ditch attempt to keep the fire from engulfing the whole kitchen while the customers, also known as us, look on in desperate hope that something won't explode. Time will tell which way Europe's fortunes will go, or if the US finally buckles under its overstretched consumer spending model. One thing is clear though, if we continue down this path with inept responses and reactive policy gymnastics at every turn, we will all pay the price eventually, whether it's through prolonged stagnation, painfully slow growth, or worse, a global recession that no one seems ready to tackle. So, folks, welcome to the global economic circus and get comfortable because this show isn't ending anytime soon.